In February 2026, the UK 10-year gilt yield hit a 15-month low, the day before the Iran war started. Most people watching the news saw a foreign policy crisis. They heard about tankers, about the Strait of Hormuz, about Brent crude. What almost nobody realized is that they were also watching their pension take a direct hit. Here's how the connection works. And it is not what you think. When a conflict disrupts the Strait of Hormuz, the oil price spikes. That's obvious. Brent crude went from the low 80s to nearly $97 a barrel in a matter of days. What's less obvious, and what actually matters for your money, is what happens next. That oil price surge feeds directly into UK inflation. Not because we import all our oil from Iran, we don't, but because oil is a globally priced commodity. When the world price rises, everyone pays more. At the pump, for heating, for every single product that moves by road. And now the Bank of England is trapped. Inflation is already above target. Wage growth is sticky, still elevated, particularly in services. And now an oil shock is pushing prices higher again. Goldman Sachs analysts say 2 rate hikes this year are fully priced into the market. Rates could go up, not down. Which brings us to the part of this story that almost no commentary mentions. When investors expect higher interest rates, they demand higher yields on government bonds, gilts. The 30-year gilt yield is now within touching distance of 6%. That is not a typo. 6% on UK government debt. And here's the detail about the British pension system that matters enormously. There are broadly 2 types of pension in Britain. Defined benefit, the gold-plated ones, mostly for public sector workers, where your payout is guaranteed, and defined contribution, which is what almost everyone in the private sector has, a pot of money, invested in financial assets, bonds, equities, things that go up and down. When gilt yields rise, bond prices fall. That's just how the maths works. If you bought a bond yielding 3% and now new bonds yield 6%, your old bond is worth less. A lot less. So when 30-year gilt yields spike from roughly 4% to nearly 6% in a matter of months, driven by an oil shock triggered by a war, every pension fund holding long-dated UK government debt takes an immediate loss. Your pension pot. The number you check on your phone just got smaller because of a war 3,000 miles away. To understand how bad this can get, it helps to understand what happened in September 2022, the mini-budget. Kwasi Kwarteng announces £45 billion in unfunded tax cuts. The gilt market revolts. Yields spike at the fastest rate in decades, and something terrifying happens behind the scenes. UK pension funds have been using something called liability-driven investment, LDI, essentially borrowing against their gilt holdings to amplify returns. When gilt prices crashed, those funds got margin calls. They had to sell, which pushed prices down further, which triggered more margin calls. A doom loop. The entire pension system nearly collapsed in 48 hours. The Bank of England had to step in. It bought gilts, emergency intervention, to stop the spiral. And here's what's different this time. In 2022, the trigger was domestic. A political choice that could be reversed, and was. This time, the trigger is geopolitical. The Bank of England cannot stop a war in the Middle East. It cannot open the Strait of Hormuz. It cannot make the oil price go down. It can only react. And reacting, hiking rates, letting yields rise, is exactly what hurts your pension. And reacting, hiking rates, letting yields rise, is exactly what hurts your pension. But there's one part of this picture that makes it worse than most people realize. Your pension is being hit from 2 directions at once. Direction 1, asset values. When rates rise, bonds fall. And if rates rise fast enough to threaten a recession, which is now a live possibility, some equities fall too. Your pension pot is exposed to both. Direction 2, inflation. The same oil shock that's pushing up gilt yields is also pushing up prices. Every pound in your pension pot is now worth less in real terms than it was 6 months ago. And here's a number that should be making front-page news, but isn't. To have what's classed as a moderate retirement, you need roughly double those figures. The Pensions Commission's interim report, published just last month, found that 4 in 10 people are not on track to meet even a basic retirement income target. Now compound that starting point with falling asset values and rising inflation. And you start to see the shape of the crisis, which brings us to the question that actually matters. What do? There is no perfect hedge against a geopolitical shock that feeds through bond markets into your retirement account. But there are things you can do. 1. Check what your pension is actually invested in. Most default funds are heavily weighted toward UK gilts and UK equities. If you're more than 10 years from retirement, that is probably too conservative and dangerously concentrated. 2. Understand that this is not a one-off. The Goldman Sachs analysis is clear. The Bank of England may need to hike rates further this summer. The 30-year gilt yield could break 6%. This story is not over. 3. The peace deal announced this week pushed Brent crude back to around $84. That's good news, but the Strait of Hormuz remains a choke point. One escalation, one tanker, and we're back at $97 or worse. The pension system is now structurally exposed to Middle East geopolitics in a way it wasn't 5 years ago. Most people never see the connection. Now you do. There is a chain reaction that starts in the Persian Gulf and ends in your retirement account. And the question isn't whether the next shock will come. It's whether your pension can survive it.